All right, so today's topic is the Self-Employed Buyer Handbook. So, helping business owners, 1099 earners, and freelancers get to the closing table. I think we can all say that this is a very big topic that does cause a lot of problems for buyers, but it shouldn't always be a problem, and that's why we're going to have this conversation today. So, first and foremost, what we're going to cover is the myth that cost deals, why self employed buyers count themselves out before they start, how we as lenders read returns, write offs versus income, different types of loan options like bank statement loans, etc., game planning, and how you as agents can help get these buyers to the closing table. So, first, the myth that cost deals. So most self-employed buyers who start the process off with a little bit of research will quickly scare themselves into thinking that they are not qualified. There's the assumption that if they call Wells Fargo or whoever their traditional bank is, and they say no, that they're completely unqualified to get a mortgage, and because of that, they just don't do the process and tell you, you know what, we're going to wait a year because our loan officer told us. The reality is that there's a lot of options for self-employed buyers. They're not all alike, and each self-employed individual will have a unique set of circumstances. And there is a reality that some won't qualify, but if they've been turned down from a more traditional lender, or they've psyched themselves out by looking at Google or ChatGPT or whatever it is that they're getting their information from, there's more likely than not we can get these clients to the closing table. And the other thing that is a common talking point for these self-employed individuals is the cost. They may walk away from the home because of what they perceive as the cost of doing a self-employed type transaction, and we're going to dispel some of those myths. So how do we read returns as lenders? So this is kind of first and foremost one of the most important parts of working with self-employed individuals is as a lender being able to actually read returns. I've been in this business for 11 years. I've worked with dozens and dozens of loan officers throughout that time. I cannot tell you with a straight face how embarrassing it is that most of them don't know how to read returns, but there is a substantial portion of lenders that just have no idea. If a lender doesn't have an idea, the chances are they're either going to put your client in a bad position because they read it incorrectly where they thought they were qualified, or they'll put them in another bad position, which is they thought they weren't qualified when they actually are. But reading 2 years of returns is kind of the general rule of thumb for traditional financing. We always want to look at income over time, especially for self-employed individuals, and this is typically how it's done. We do look at add backs, so we don't always take the net income that you see on tax returns. There's several categories that can be considered add backs to their income. So certain categories like depreciation, we can add that back, and if they wrote off a ton of depreciation, that could be the difference between qualifying or not qualifying. There is, the importance of a trend. So we want to see that they're trending either net neutral or positive year over year during that 2 year period. If there's a significant decline in income, this can be an issue, and why we may need to pivot into looking at a type of option that doesn't look at tax returns. But for us, when we're looking at more traditional financing options and we are working with a self-employed individual, we typically ask for their personal returns and their business returns if that is applicable to them. Now, the conventional self-employed rules is typically a 2 year history of self-employed income with 2 years of returns. This can be reduced to 1 year if, in fact, that individual is working a 1099 job that was W-2 before in the same line of business. Doesn't have to be the same company, but if they were in the same line of work and they just converted from W-2 to 1099, just need 1 year of history and returns and can do that. But the general rule of thumb is 2 years. We can sometimes omit looking at the 2 years tax returns as a whole. If that individual has been self-employed for 5 years, there's many cases that we can just look at the most recent 1 year of taxes and use that to determine what our income figure will be. Now, net income is usually kind of a good rule of measure. But again, going back to the previous slide, we can't add back write-offs. So it's not just the net income, it's net income plus some write-offs and add backs that we can get a bigger income picture from. Now, sometimes we do require a CPA to maybe write a letter, depends on the circumstances, to support that the business is in good standing, so on and so forth. And as I mentioned before, we are looking at trends, but this is the overall, when you're looking for traditional conventional loan option, this is kind of what we're looking at as loan officers. So when I'm talking to a client who's trying to do a loan and they say they're self-employed, I'll be honest, I always ask if they're okay with us starting with tax returns, because some people, going back to earlier parts of the slides, they don't know, they don't know what their actual incomes are. They don't know if they'll qualify or not qualify. I rather know, because these loan options are going to have the better, interest rates, and it's going to be the cheaper costs. I rather know for sure that I'm doing them a service by taking them away from the conventional product before. Now, not every client wants to do that, and some clients have a reason for it. And so for that reason, in those one-off scenarios, we'll just go to the other loan products. But I typically, if you send me, a self-employed individual, I'm always going to coach them on, let's try to see what we can get out of the returns. And if that doesn't work, go in a different direction. So write-offs versus qualified income, for those who look at their taxes, that, there's a lot of things that you can write off as a 1099 or self-employed individual. You can write off mileage, meals, for certain types of businesses, depreciation, all sorts of things that you can put in there, labor, marketing, all the line items, right? And so obviously the more you write off, the cheaper your taxes will be, maybe a refund, so on and so forth, depending on if you prepay. And so, a lot of individuals will do that. And that's a tax time win, as we call it. But those write-offs, give us a lower income figure, and that could cost, your clients the ability to qualify for the home that they're looking for. So our goal is to look at everything, look at their taxes, look at other options, and finding the balance that can help get us to where they need to be based on their goals and objectives. So when do we switch to an alternative loan option? Well, like I said, I always start with a conventional loan because it prices the best. I'll move to an alternative loan option if the tax returns don't show what we need it to show based on what their goals and objectives. So where a conventional makes sense is where they have 2 years of returns showing enough net income. Their income is going to be steady or rising year over year, and the business is in a good, support session that it supports everything. And this is where, for clients that, qualify for all this, they're going to get the best pricing, and they care about that. Now, why we'll make the switch to an alternative loan option? Well, they have a lot of write-offs, and because they have a lot of write-offs, we don't have a lot of net income. The buyer doesn't want to wait or refile their taxes, or they decided to take advantage of a big deduction year because they have the ability. But these are, the reasons that we would look at alternative options. And, as long as they have a good cash flow or 1099 history that's there, we have an option that we can take them to. So these options are first and foremost the bank statement loan. This is the one that you've probably heard of the most from anyone that's ever told you about alternative loan options. Bank statement loan is a very straightforward loan product. We either take 12 or 24 months of bank statements, and we take in all of the deposits that are not transfers, but deposits from, active business dealings, and we sum total those and divide that by whatever the number of months is to get a income figure for each month. Okay. Now, it sounds super easy, but there's a little bit that goes into it because not every deposit's going to count, but more often than not, the business bank statement loans are pretty good options. If your clients feel like they're in a good enough financial place to not only run their business, but buy a home, generally speaking, their bank statements will qualify them to purchase a home. The next option is a 1099 income loan. This is very straightforward. It's where a client just provides a 1099. We don't look at their taxes. We don't look at what write-offs they might have done, and that is how we qualify. And then the last option is a relatively new-ish option. It's been around since I've been in the business, but I just haven't seen that many people take advantage of it until more recently. But it's called a P&L loan. So P&L is where we get a statement provided by the CPA, certified on what their income and all that is, and then we use that to qualify them. So these are kind of the three big ones right now for alternative loan options. Bank statement loans, again, they're 12 or 24-month loans. We can look at either personal or business bank statements because not every self-employed individual has business bank statements. We average the monthly deposits to create the income. Each bank statement investor that we work with has an expense factor based on the type of industry that the buyer works in. So, for example, if they're in service industry, they'll have this expense factor that we'll hit them with. If they're in, something else, like real estate, it's a different expense factor. But what an expense factor is whatever that net income is that we average out each month, we times it by that factor. So we may only be able to give them 75% of their net income that we've averaged, or we may only be able to give them 50% based on the expense factors that are levied to the industry. This is where it's a little, I don't want to say difficult because I really don't find the bank statement loans difficult, but this is where there is some nuances that can make it not so clear cut for bank statement individuals. And this is part of why when I do my initial call, I'm always asking those big questions of what it is that you do for work and all that stuff. But that is a big factor in how the qualification is done. Now, it's very important for bank statement loans that we don't use taxes, W-2s, or 1099s. I've had a bank statement loan in the past where the client paid themselves a W-2 and they wanted to use the W-2 to kind of maximize all their income. And I said, can't do that. We can't have the tax forms on there. That creates a separate issue. So, we really are only looking at those bank statements for those clients. It's a best fit for owners with strong cash flow, but heavy write-offs. Buyers who want to understate their actual income, and generally self-employed individuals that have 2 years or more of history. Usually these options are going to be 20% down, but occasionally you can see them down to 10. When you do see it down to 10, it's a very, very, very expensive interest rate. So, we always coach clients to prepare for these types of products with more money down. The rate is going to be typically higher than that of conventional, which is why I always try to go conventional first. And there's usually some reserves that are required. Now, it doesn't matter if the reserves are, personal or business bank statements. We just have to find reserves somewhere and be able to document the buyer has full access to those funds, and then they can use that as reserves. Ideally, for clients that we do these types of loans with, and it's not always the case, but ideally we always look to help them in the future get out of the bank statement loan if they can, to take advantage of the lower rates that are typically offered by a conventional loan. So if while we're preparing them for the bank statement loan, we can see kind of what they need to work on in the future, we'll coach them on that. But it's not a requirement that they refinance this into a conventional loan in the future. Oops. There we go. 1099 income loans. So again, these are relatively straightforward. We're not looking at the taxes. We're only looking at 1099 statements, and we use an expense factor based on their type of business, and that is where we get our income from. This is usually a best fit for contractors, the gig workers, some commission earners, so on and so forth. There's a lot of people who are 1099 that as soon as they realize they can write off all their expenses, they do. And then they just can't qualify for conventional. So just going off their flat 1099 income with an expense factor, great way to qualify. And they're usually, like I said, 20% down, but there is some exceptions, and the rate will be a little bit more than the conventional loan product. P&L loans, these are a little bit tricky, even though it's straightforward in the sense that we just need a statement prepared by a CPA. If you've worked with a CPA and asked them to do anything with a client before, you understand that that is a very uphill battle. So this is not a loan product that I go to on a quick decision basis. This is something that I would do in a situation that I would absolutely need this product for the client to qualify, because the CPAs are not going to make it easy for us. A CPA is always worried about liability, and they want to make sure that everything that they put in writing is consistent for their client, and as they should. And there's a lot of CPAs that are part of organizations that refuse to write letters. So we sometimes have to work really closely with the buyers to have their CPA prepare what we need. But if we need to go this route, essentially what we need is a prepared year-to-date profit and loss statement from the CPA. We might be able to pair it with bank statements, and the qualified income is going to come from the P&L. So based on whatever the CPA writes as part of the P&L, that's the income that we're going to be able to use as qualifying income. This is going to be best for owners with clean books and a really good CPA that's not going to be scared to write this up. It's not a big deal to write a P&L, but a lot of times when they're working with lenders, they get scared. And so, having a good professional CPA that understands kind of what we're asking is huge. This is going to be the lightest of documentation loan product, but probably more difficult, in my honest opinion, than the bank statement product. Bank statements, you just log into your banking portal and you grab your statements for the last 12 or 24 months. And yes, it's a tedious task for 10 to 15 minutes, but once you're done, you're done. But going back and forth to the CPA, that can take well more than 10, and also is going to require some money. So it's not the easiest to do between them, but it is the lightest in terms of documentation, if that makes sense. The CPA has to be licensed, so it can't just be someone that does the taxes. It has to be an actual tax preparer slash CPA. And again, we're talking 20% down as the norm, with some extenuating circumstances with less. And this is a great product for clients that are, again, not preparing their taxes in a way that's beneficial for mortgage lending. So which loan fits the right type of buyer? So 2 years of solid returns, usually that's going to be conventional. There'd be very few reasons not to go conventional with that. Strong bank statements but heavy write-offs, that's a classic bank statement loan. That's probably not going to do well in the P&L either. So, bank statement loan is going to be best fit for that type of client. If they're paid 1099 and have, a lot of deductions on their taxes that make it so they don't qualify, great. We're going to do the 1099 loan. Again, a P&L would probably not work out in their favor. But if they don't have, a lot of crazy stuff on their taxes, they just, for some reason, don't qualify on the most recent tax year, but we've got a P&L for the last 12 months that help us, then that P&L loan is going to be a great fit. And then significant assets but limited documentable income. This is an option I didn't talk about in the previous slide, but asset depletion. So if client has a lot of assets between business, personal, so on and so forth, there are asset depletion loans that will allow us to take whatever that balance is, divided by 3, 5, or 7 years, and get an income figure. And that will allow us to qualify them. And again, similar terms, 10, 20% down typically, getting them access to a mortgage loan without having to go through all the hoopla of, all the other things, tax filing, so on and so forth. Now, one of the common pushbacks that we get from self-employed individuals when we're going through these options is, the rate's more expensive. It's 0.5%, 1%, whatever the case may be, more expensive than the comparable conventional option. So why should I do this loan? Well, there's what's called the cost of waiting, right? So, option 1, wait and file for higher income, extra taxes to report higher income. You have $24,000 in extra taxes that are going to be due when you do get that higher income. The home price, on a $500,000 example, it appreciated $40,000, over that period. And, you've got no rental equity because you paid rent. So your cost of waiting based on my option 1 example here is $65,000. So in addition to, home prices getting more expensive, you've paid a higher tax burden. So you've cost yourself $65K. Now, if you took advantage of one of the alternative loan products today, where, yes, you have a higher interest rate, but you're being able to buy a home, you pay an extra $9,000 comparable to a conventional home loan over a 2 year period. And you've appreciated your home purchase by 40K based on that 4% assumption. And so your real only cost here is your extra rate, and that's $9,000. So I think if it costs me $9,000 to make $40,000 over a 2 year period, I think I'm paying that 9K all day. And so, when I'm working with self-employed individuals and I'm trying to overcome their objective or objection of, well, the rate's a little too high for my liking, we talk about the tax burdens and, would you rather pay more taxes and get the lower rate, or would you rather pay less taxes and pay a slightly higher rate that's not going to be anywhere close to the amount of tax that you would owe and still be able to get your home in a timely manner? So usually when I show this to these individuals, they absolutely get on board. It's just, that initial moment of, oh gosh, the rate's higher than what I'm seeing on market on Google and ChatGPT, whatever. And just getting past that initial freak out.
Quick question.
Yeah,
So in that scenario too, it looks like we're implying that the refinancing has no cost.
we're not implying that the refinancing has no cost. We're not taking into account a refinance because it wouldn't be comparable to renting anyways. Because if we're looking at our option one, they still haven't purchased, so they would still
Hmm.
have their purchase costs. So that would be a wash between the two. So I'm not
Gotcha.
taking into account that.
So
And
you're
even if
factoring, right, you're factoring the origination costs into the refinance. I get it. Okay.
and
This does
yeah,
make sense. Yeah.
yeah, and even if we did put that into a line item to make it look a little bit worse, we're talking 3 to 5K to do a refinance, right? So, our cost is less than 15K to buy versus the cost of waiting is in the 60s plus.
Right.
So it's like I said, when I have self-employed clients, Dan, that, give me that pushback, it's not about what I say, it's about what I show them. And when I show them this, they're usually like, yeah, that makes way more sense. And if they're still a little bit on the fence, a lot of times I'll tell them to talk to their CPA. I'll say, well, this is what you'll need to do to qualify for what you're looking for on a conventional home loan. So talk to your CPA based on your gross income. This is the net that you need to have. So talk to them about what that tax burden would look like. And it's pretty quick when they get off the phone with those CPAs. It's pretty quick that they're like, Ian, you know what? Actually, you're right. Let's just talk about these options and see what that looks like, and we move forward from there.
Nice. Yep.
Yeah. So the 1 year game plan. So anytime you as an agent, have a client that you come across that's self-employed, it's very important that they talk to a lender early. Time can sometimes be a real harmful thing. If we go past certain timelines, then they may have to wait 8 9 months. If so, say for example, you talk to a client in January, but they weren't ready to purchase till summer, and then they talk to me in June. Well, they've already filed most likely by April, and so now we would have to either amend their taxes or wait till the following tax year to be able to fix anything if they wanted to do a conventional home loan. So it's important that we talk to them early so we can at least plant the seed early of what to expect as far as their income goes and how they filed is concerned, and if they need to make changes based on their goals, objectives. Also as part of that is tax planning. So balance their tax savings with the income that they would like to qualify. I do provide that advice. I'm not a CPA, I'm not a tax preparer, but what I am is a mortgage professional. And I do know what income is needed on taxes to be able to qualify for their various purchase prices based on their debt picture. And so I can look at their current and I can say, this is what you need. And they can go back to their CPA or tax preparer and work through that. Having clean records is very helpful. So if you're talking to them as a lead, it's important that they kind of put their taxes together so that when we do have that intro call, we can actually, see that information sooner than later. I did have a relatively interesting scenario recently where I had a client that had their 2 years ago tax, but they didn't have last year's tax and they couldn't find it. And, I couldn't issue a pre approval without it. So we were kind of handcuffed. So, when they first talk to you, they're self employed. I would ask them, hey, have you filed taxes the last couple of years? And if so, it's good to have that ready for, when you make the introduction. And then, as we've discussed, these alternative options for the buyers that need the alternative loan options, they are not low down payments. They're 10 to 20%. So if we know and they're planning for their home purchase and we know they're self-employed, we should go ahead and part of that early stage of talking to them is preparing them for what they may need to bring to the table, and so building that down payment as part of that plan is huge.
Mm-hmm.
Now, how you can help as agents is, like I said, spotting them early. Is when you're
No,
talking to clients,
sit
I
down.
don't. Oh, Delilah, I think you're off of mute. There you go. Spotting them early. I don't know, Sam or Delilah, your process when you first talk to clients, if you do ask specifically what they do. But if you get an indicator that they are self employed, again, the loop in early is super helpful. And part of that, I would plant the seed on the expectation that their qualification is important to start soon, rather than like a month or so before they're ready to purchase, because of everything that we mentioned before. We may need a little planning with the down payment. We may need or want to look at their taxes a little bit or plan their taxes if it's tax season or coming up to it. Or they may just need time to work with a CPA if they're doing a P&L, so on and so forth. A million reasons for why time is helpful on these types of loans. So the sooner we talk to them, and are able to identify that they are self-employed, the better. That way we can limit any failure to deliver on their timeline goals of when they want to purchase. So I know I said a lot of words, and Sam, I know you've been here the whole time. Delilah, you just popped in a few moments ago, but Sam, Delilah, any questions that you all have regarding what we spoke about? I know is a lot of content.
I have a quick question. This may be a little naive, but I'm a still a new broker.
Okay.
So this was really informative about the alternative loan options. Is this something that would be included at all in the offer, or is it purely on the back end for the buyer to kind of get their financing in order? Or would they have to disclose, oh, it's a non-conventional loan potentially, and therefore, it's less, maybe it's a less attractive offer if someone has a conventional loan offer alongside. I don't know if you
Great
know,
question.
but yeah.
No,
Yeah.
great question. So, generally speaking, we're not going to be disclosing to the sellers, that the buyer is self-employed or doing an alternative loan option per se.
Okay.
Usually, the pre-approvals will come across, no matter what lender you really talk to, the pre-approvals will say conventional, even if they're not, just because there's not like a uniform code for these types of products that, are required in the industry. And we don't really want to tell the sellers more than what they specifically need to know, which is that they're pre-approved for a specific amount. And so we find that we don't really have these types of dialogue with sellers or listing agents.
Got it. Okay. That's good
Yeah.
to know. And I mean, they may, if they see an offer that's got 20% down, they can draw their own assumptions from it. But yeah, money's money, right? So they shouldn't care how it's being funded.
Exactly. And in my experience of doing these non-QM loans, as we call them, over the years, I don't think I've ever actually had a listing agent question the pre-approval before. And I think the main driver behind why they don't is because they are typically higher down payments. And
Mm.
so I think there's a perception that higher down payment means more qualified. It doesn't always mean the case, there was options for getting people into loans immediately out of bankruptcy when I first started in this business. Like you could be one day out of bankruptcy, one day, and as long as you put 20% down, you could get pre-approved. And
Wow.
so, imagine being a listing agent saying, oh, wow, 20% down. This client must have everything in order in their life. And it's not always true. But seeing that, I think the perception, just being realistic with what I see out there right now, the perception is that if you see that as a listing agent, usually you don't question it too much.
Got it. Okay,
Yeah.
that's helpful. Good to
Yeah.
know.
Yeah. Well, Sam, I definitely appreciate you jumping on the call today. I know Delilah snuck in at that tail end there, but this presentation, I made it all for you. Welcome
Yeah.
to North, welcome to the team.
Thank you.
Um, I look to be a resource. I do these every Tuesday, by the way. I
Great.
try to come up with concepts of topics that can be, important for, agents. And sometimes I do really well and I get, 20 people show up. And other times I've got, my one and only friend here, Sam, to watch me a bit. I do them. And if you ever need anything, have any questions about financing or have a client looking to get pre-approved, you're more than welcome to reach out to me. I am curious, do you have a copy of my details, like my link tree and all that?
I don't is it in the I know they put I think your email was in the some of the onboarding documents, but I'm not sure uh if I'm missing something. I just joined recently. So,
Understood. I
yeah.
think that they probably don't share my link tree. I know they put my email and such in there, but I just
Okay.
typed in my vanity link for my link tree. So I
Oh,
brand myself
great.
as the CLT mortgage guy, but it has all my videos. So if you want to just one day just want to cram in some Ian content,
Yeah.
there's probably 20 videos in there that I've done. And it's of course has my
Nice.
emails. It's got my phone number, Instagram if you want to follow me, all of those things. So
Oh,
definitely feel
that's
free to check
great.
that out.
Sure. And on the note of every Tuesday, do you have a kind of index of topics that you're going to cover, just so I can look ahead and say, oh, this one, definitely don't want to miss versus this one, I already know this content, etc.
Yeah, so usually I post on Friday,
Okay.
both on my Instagram and on my various Facebook groups that I'm in, what the topic will be.
Okay,
I
cool.
don't typically decide until the week, the end of the week, for what's happening on that following Tuesday. So I don't have a lot of forward planning. It's actually something I've been meaning to work on just so it makes my life more organized and easy. But I usually just do Thursday or Friday morning is when I make that initial post. And then that gives you a couple of days of heads up leading into that Tuesday if it's worth your join or not.
Cool. All right, then yeah, thanks for the link, and I'll definitely look out on Thursdays or Fridays and see what the upcoming topic's going to be. But thanks again. Yeah, this was really interesting.
Yeah, well, I appreciate it. I'm glad you found some value and best of luck this week. And I'm sure we'll talk soon. Okay.
Yep. Thanks again. Have a good one.
You too. Bye, Sam.
Bye.